Hi, everyone. My name is Travis Schwab. Welcome to a scintillating conversation about the impact of Reg NMS, their changes to Reg NMS on exchanges, market surveillance, and order routing. With me is Adam Inzirillo. Adam, hello. Welcome. Thanks.
Hi.
Adam has been in the brokerage business, like myself, for 20 plus years, equity business, and he's moved over to the Cboe as of about a year ago. Is that accurate?
Pretty close.
Pretty close. Good. Welcome. Really happy to have you here. Adam is an expert on everything market structure, equity market structure. So we're really excited to have him. We're going to talk about a lot of different things here. One of the things I want to emphasize is we really want people to ask a bunch of questions. Obviously, if everyone asks for that, but we mean it. We would love questions. We'll answer them as we get them. Should be pretty straightforward on asking it on the GoToWebinar control panel, but if you don't see the question area, there's this little orange arrow. Click that and you should see the panel then open up for you to be able to ask questions. So ask them early and often. We'll answer them the best of our ability. All right. Also, for those playing at home, in case you really want to spice up the webinar and throwing a drinking game on that, every time we say unintended consequences or undue complexity, please drink on us. We will not be doing that ourselves, but please imbibe to spice things up a little bit. So with all those logistics out of the way, let's talk about what we're going to talk about today from the agenda standpoint. We're going to talk a little historical context about what's happening in the equity markets. I think it's always valuable to connect the regulatory and the historical aspects of things are always intertwined. And I think it's important to keep that context in mind as it relates to the changes proposed during Reg NMS. We'll talk about what we think actually needs to be fixed in the equity markets today. We'll then dig in a little bit more on the various proposals on Reg NMS or the various changes being proposed. We might dig in a little bit on order protection, and then Adam and I will think about adding some predictions about where we think things are going forward. So that's the agenda. I'm sure we'll move off of that or try to stay on it as much as we can. I wanted to just give a little thought before we get Adam here contributing is think about the last 20 years of what we've seen in the marketplace, both from regulatory responses and then the macro shocks that happen into the marketplace. We've just had another shock, kind of the first quarter with COVID, and I think it's important to keep that in context as we look at the various ramifications and market structure changes that have happened over the last 15, 20 years. So this is just a partial list. You could add market access changes, decimalization, Reg ATS, 201, 204. There's lots of kind of big market structure aspects of where we're at today. But Adam, just kind of start us here, looking at this historical context. What do you think is kind of working today in the marketplace that, where we're at 20 years post kind of Reg NMS, the first version here?
Yeah, so thank you for having me, and I appreciate everybody joining and listening in and hearing us today. I would say the biggest thing is, like, if you take a close look at what's happened since the beginning of March of this year, is the resiliency and the uptime that we saw from most market centers over the last several months. So we haven't seen this much volatility since 2008, and I think if you go back dating to 2008, you had Rule 201, Rule 204. T that helped fix a lot of things around short sales and close out requirements. We've seen a lot occur since the flash crash in May many years ago, where we saw limit up, limit down. We saw a number of other things come about, even from a lot of the broker-dealer debacles that happened in 2013. We saw some SDLC procedures that came into place. We also saw Reg SCI also come into play, and I think that really helped us navigate through all the extreme volatility and volume that we saw in March, April, May, and June. I know there was a lot of major operational effort from a broker-dealer standpoint, as well as the exchanges, So it's one of those times or efforts that we all came together as an an industry, and actually worked with our regulators to come up with appropriate methodology to ensure the integrity and the stability and uptime of our markets. And I think that was really beneficial as we've seen over the last several months.
Yeah, I think that's right. And if you think about a lot of these structural changes or regulatory responses have happened as a result of these kind of macro shocks, right? You just mentioned a whole bunch of them, whether it was a financial crisis or the dot-com bust or any of these things. With this recent shock, do you see, let's maybe separate NMS changes, but just do you see a lot of need for regulatory changes because of the recent kind of shock in the market, or did we handled it perfectly and everything's great?
Well, I think it would be really difficult to say there wouldn't be any regulatory changes coming down the pipeline. I think we go in ebbs and flows on that. I think there's a couple of things they're focusing on. Obviously, we had all the market-wide circuit breakers. We had 4 of them take place in March and April. And I think the thing about that is they're looking at ways, well, it happened right at the open, is there's some ways that we can improve on that. So I know that task force started well before a lot of the volatility that we've seen. So maybe something comes out of that. I don't see anything overly pronounced. Obviously, there's the NMS II debate as it relates to the infrastructure market data proposal, but which we can get into a little bit later. But I don't see anything significant or overly intrusive to our industry, like we saw maybe in Europe with MiFID II that happened over the last couple of years. So I don't envision anything major other than a couple tweaks here and there as it relates potentially around market-wide circuit breakers.
Okay. You talk obviously to a lot of your exchange customers, your investor base, so on and so forth. Are they feeling like the market is being responsive to them? Are they overall, their experience has been positive to where they're not clamoring for a bunch of changes, or there is some consternation and the market's not fulfilling their needs as far as your customers are concerned?
Yeah, I think it does vary based on who you talk to. I think the beauty of our industry is that you have multiple constituents that have different viewpoints about what needs to get corrected or what needs to be able to get fixed. I think for the most part, though, everyone felt the markets handled the extreme volatility and volume very well, ranging from off-exchange trading centers to on-exchange trading centers. There was some, market speculation around clearing and settlement that I wasn't as close to, so it'd be difficult for me to comment on. I did hear a little bit on that angle from some folks in the broker-dealer community, but for the most part, I think everybody felt like it worked well. And now we're getting back to the new topics, whether it's market data fees, connectivity, transparency, market manipulation. So these are some of the things that I think are starting to come about that kind of were pushed aside over the last several months, due to all the volatility and volume.
Okay, that makes sense. Yeah, we're hearing the same thing from our customers as well. And I think overall, you just look at this continuum of resilience and kind of work that has been put in, and I think overall that the efforts have been paid off. Like, you see the infrastructure, you see the resiliency of not just the equity markets, really down the line. A lot of these big asset class market structures have stood the test of time over this last shock. Moving kind of, we've talked about obviously the things that are working. Now let's maybe shift that gear a little bit and talk about maybe those specific points as it relates to the NMS changes and but those specific things that aren't working necessarily for all your constituents. So maybe pull out maybe 3 or 4 of those things that you think need a timely review right now.
Yeah, I think it'd be difficult to say that things aren't working. I think the market itself is fairly efficient and it works very well. And I think when you start putting these things in context, unfortunately, a lot of people just read what's in the media and the publications, and we have a couple of market structure pundits that like to sensationalize a lot of the issues that we have. But if you think about the equity market, it's fairly transparent, it's fairly efficient, it's evolved tremendously since the late 1990s, whether it's limit order display obligation, equal and fairness rules around limit order and market order manning. We also saw decimalization. We saw Reg NMS, which helped protect the public market, which seems to be a new debate, do we still need to be able to protect the public market? I think the biggest thing is, we've seen an increase in off exchange volume. I think there's extreme value to that, but you also have to look at it where if you go back 15 years ago, on the floor of the stock exchange, you may have had 100 people, represent on the floor, so you could be closer to point of sale. Now that's moved to having your surfers closer to the point of sale, whether it's in Mahwah where New York is, and Carteret where Nasdaq is, or in NY4 and NY5 where we are. Now you have the servers. So it's taken a lot of that liquidity that used to sit on the floor, or whether it's an upstairs trading center, and put it out into the public market. And there's been a lot of good that's come out of that. We had Reg NMS obviously there was a lot of headache in trying to get them all published and getting them out there for everyone to consume. But that created more transparency. And I think we've all moved in the right direction of moving some of that liquidity that always sat at the big broker dealers or the floor exchange, got it out into the public market. And then we focus on transparency, and we seem to move away from that. So from my view, I think it would be really important for us to start focusing on transparency and understanding what really is going on in a market, and not do something overly intrusive. You could potentially do something on a smaller scale, utilize data to make a proper decision going forward. But right now, everything seems to be so sensationalized that it's skewed one way versus the other. But I think if we all took a step back and look at things in context, I think taking a smaller approach going forward would be very beneficial to the overall industry.
That makes sense. And are you concerned, and we'll kind of dig into some of those transparency topics going forward, but just even on the current state today, you think about, there's been some articles recently about the payment for order flow, Robinhood, you have these you have a big consolidation of the retail flow, right? Retail flow is around 15% of the US equity market on a daily basis. The majority of that is going to a fairly small set of wholesale market makers. Are you concerned at all about that consolidation, that kind of lack of competition? Do you think that hurts the market at all, or no? It's not something we need to be concerned about.
No, I think if you look at all the articles that have come out about payment for order flow, one is it's part of it because now you can actually see the dollar amount paid, right? In old historical Rule 606 statistics, it gave you an average cents per share. It didn't give you any really statistics that were specific, where now people are able to see how much payment that exists out there. I think you have to put it in context. There were a couple articles written also that I don't think were fair to wholesalers. There's value in wholesalers, meaning they provide principal executions. They're able to provide executions within the spread and provide a level of EQ that you may not be able to get at other market centers. But I do think the time is right to take a look at how exchanges are able to be unique and provide innovation and foster competition. For example, we recently just launched a new order type that helps mitigate against adverse selection. Went out for a 21-day comment period, and then took 45 days for action. Then that was extended another 45 days. So before we can actually launch it, it's available for public consumption. You kind of lose a little bit of IP from it. And then on top of that, you have to wait 90 days. And some things get pushed out pretty long, where you're looking at 240 days. And even, for example, CMC, which was a alternative to the primary stock exchange closing auctions, that took over 3 years. So I think something needs to be done on that end, so exchanges, particularly Cboe, can continue to innovate and be unique relative to its peers, but also at the same time be able to compete with off-exchange market centers and give investors choice and flexibility about where and how they want to be able to route order flow to.
Yeah, that makes perfect sense. Yeah, it's hard to plan when things take years in the making, isn't it? As far as
yes,
being innovative there. Well, I wanted to dig in a little bit on that. As you spent the majority of your career on the broker-dealer side. You've moved over to the exchange side. Lots of comments, lots of discussion about conflicts of interest, especially as it relates to market data and SIP governance, and we'll kind of move into that. But in general, do you find that your viewpoints have changed or become enlightened now that you're on the exchange side? Kind of just what is that evolution between those two sides of the world for you?
Well, it really depends on the topic we're going to talk about. No, but I would say, one of the reasons why I took the position at Cboe, one, I felt like Cboe was in a unique position relative to its peers, given the asset classes that it services, as well as the depth and breadth of products, whether it's, VIX and XPX products, or a global offering that we have in Europe relative to the US. So it was a unique opportunity for me to be able to join a company like Cboe, who's also been a leader in technological development as well as it relates to matching engines and connectivity and so on and so forth. So that's been a great experience. I would say, in addition to that, it gives you a totally different view of the market, right? So a lot of things that you hear in the industry today, whether it's through, papers or other folks, communicating, like, for example, the transaction fee pilot, where, everyone felt rebates were such a conflict of interest. I think things like that you start to realize are somewhat overblown. And, if you can think about what MSAC, which is the Equity Market Structure Advisory Committee, when that was originally put together by the SEC, they focused on the conflict of interest as it relates to fees. And they had an element of reducing the 30 cents a 100 down to 10 cents a 100. And for whatever reason, we moved away from that and focused more on rebates. And I think exchanges, have to be able to compete. And one way to be able to do that is through its pricing mechanism. So it's a unique opportunity for me to be able to view this all, whether I've been at the broker-dealer, but also on the exchange side now, and you can actually see the interaction with regulators and the different constituents in the market. So the key for us, Cboe, as we continue to grow our equity brand, is to be a voice of reason in the industry and put forth data and other interpretations so the investing community can be educated about how they trade in the public market as well as off exchange.
That makes perfect sense. No, it's good. Hey, I've gone from, buy side, exchange side, vendor side. Definitely the exchange side is much more enjoyable than the vendor side from a engagement standpoint. I always feel buy side, exchange, then you got the brokers, then you have the vendors fairly low on the totem pole. So I think you're in a great spot, and Cboe's lucky to have you. We got a question here, thankfully. Do you think the growth of SIs are a positive development for overall market price transparency and or efficiency?
So SIs, I would assume that systematic internalizers, that's, the general nomenclature is more used for Europe, but it's the basic premise for those of whom are not aware of an SI can also be used with single deal platforms, otherwise known as SDPs. And if you go back to the old direct edge days, they were called enhanced liquidity providers, or ELPs. So that market has grown. We've seen it take off, obviously, in Europe for a number of reasons, whether it's, BCNs are no longer applicable, which is basically an ATS in Europe, where in the US, ATSs have been relatively stagnant or, remained around 11 to 12%. You've seen some of the single deal platforms grow. I don't think it's hurting price discovery to an extent. However, if you remember what I mentioned before about the transaction fee pilot, we talked about fee avoidance. So I think at some point, firms need to be able to have properly documented policies and procedures that are able to understand why they go to certain market centers versus, say, the public market, right? The public market, you have known price, generally speaking, and you have known size, generally speaking, where some of these off-exchange venues, particularly in SDP, it's not widely publicized. You may have an indication of interest that you incorporate into your market data feed, and that helps justify your routing. But I think at some point you have to weigh the appropriate balance between an opportunity cost of going to a single dealer platform versus the public market. And I think as a result of that, there's probably a greater need for more transparency around those market centers. So I would say
on the 606 type transparency, or different. You're looking for something different there.
Yeah, way I would correlate it to is, if you remember, Reg ATS was created in the late 1990s. That was so basically allows you to bring an electronic market where you can anonymously match buyers and sellers, but not go through the same arduous process of filing as an exchange, right? So that helped foster competition. And what they did was they realized over time that more information needs to be publicly available. In addition, they need to change the procedures about if you want to make a material change to it, and so they created ATSN. The key difference between an SDP and an ATS is twofold. One, when you trade against an SDP, SI, or an ELP, you're trading against a single counterparty, and the executions are in a principal capacity. And number two, the other key difference is that they are not required to file with the SEC to provide other disclosures and transparency. So one benefit potentially that we could take a closer look at is, should they have the same requirements as an ATS? My answer to that would be yes. And I would feel that way whether I was an exchange or a broker-dealer, because I think providing more transparency, more disclosures about the function and operation of a particular market center, I think is extremely beneficial. So then there isn't so many questions or skepticism or sensationalizing that happens in the media. So I think that would be, in my view, something that needs to happen from a transparency standpoint.
Speaking of that makes a lot of sense to me, Adam. And it sounds, obviously, the general trend is markets are better when they're more transparent. If you just look at the continuum of time, regulations a lot of times push transparency, which pushes safety, which expands the size of the pie. And so we've seen that in markets, and we see that market structure working really across the board. Another question around exactly kind of what you're saying around non-ATSs, what requirements they should have, or STPs, is why, this is a question from our audience, why aren't non-ATSs or STPs required to comply with Reg SCI in your mind? Should they be, or should other venues be subject to SCI?
That's a tricky conversation. So if I put my BD hat on, I would say no, because there's a lot of operational headache. Keep in mind, there are some procedures that you can put in place to ensure that you don't hit the SCI threshold, right? So keep in mind, there's a threshold to become an SCI venue. I forgot off the top of my head, I apologize, otherwise I would comment on it, but there is a threshold in terms of volume that you need to be able to hit before you become an SCI.
I think is what it is, somewhere around there, right? I thought it's around %. But anyway.
Yeah, you would get hit on a symbol basis, and then you would also get hit on, and it's all notional based, if I understand correctly. So it's on the market center, and then on a symbol level basis. So I think it's 4 out of 6 months that you then would have to become an SCI compliant venue. So I guess that's a good question. I think the difference is, though, if you start adding in the broker-dealer or the SDP as becoming SCI compliant, now you're going to trickle down all to other systems within a broker-dealer, whether it's back office, middle office, clearing and settlement. So it gets really difficult, and I think it really adds a significant burden to the industry. Before we even get to that element, I think it's important for more of that information about how they operate and how they function, how they price things, how they trade, getting that information out there publicly, and then we can figure out, is it necessary for them to be an SCI entity? And probably the question is, where does it actually stop thereafter, right? And when you start getting to middle office and back office, that's where it starts to become a problem.
Right. That all makes sense. Great questions coming in. Keep them coming in. We have some more here, so let's keep it going here. Is again around the single dealer platforms or the ATSs or any of the non-public exchanges. We have a question here. Do you feel price discovery actually takes place when the listed equity markets have become bifurcated into public and private marketplaces?
Yeah, I think, if I answer very bluntly, I would say price discovery has been hurt somewhat. It depends on how you're viewing that. I think, individual investors, and when they log on to their online broker-dealer account or work with their FA, they send an order into the market. From their perspective, they're getting the executions that they need to be able to get. However, if you think about history, not to date myself, but 11AC1-4, when that was created back in 1996, which focused on the importance of limit order display obligation, which is now in the FINRA 6460, and a number of other rules. It talked about the benefit of having that limit order available in the public market. So one thing that we have done, Cboe, is we created a retail priority order type that, whether you go through a wholesaler or you come in directly to the market, we're totally indifferent to that. But what it does do is it allows the non-marketable limits to be able to come to the public market, which allows the market participants to be able to interact with that liquidity. So we've taken another step and said, listen, for us to coexist and to be able to compete with that, let's be unique in our offering, and we put that out there to a ton of success. But if you also remember, and if you go back to early 2000s, I think it was on the Atkins, they wrote a whole paper or follow-up as to what happened once they made that rule change around limit order display obligation, and they saw tighter spreads. They saw improvement in size being displayed in the public market. And I think, sometimes that hurts a little bit where those orders were normally, whether it's a non-marketable limit, either from retail or institutional. Keep in mind, people have different characteristics associated with their orders, so that also helps drive where it goes. But for the most part, I think there has to be some type of equilibrium reached where the exchanges can be able to compete with it and help foster some of that price discovery that I think has been lost over the last, 2 to 3 years.
Along those lines, perfect question right off here, and we'll just keep answering questions because we love it. So just keep them coming, and we'll deal with the just as far as the question on options and crowded marketplace with Reg NMS. We'll talk about that momentarily. But again, off exchange volume question. Some cases approaching more than 40%. What are your views on dark trading, and how does Cboe intend to compete with these venues?
Yeah, I think I've been pretty vocal about, off non-display liquidity. There's value to it, right? Whether it's, I have a very passive algorithm and I want to minimize market impact. I'll look to trade in ATSs, and, I only trade against high net worth or institutional type flow. I only want to trade against low alpha flow. Every ATS offers a different mechanism by which that market participant can adjust who they trade with and how they trade with. The public market can't do that because of fair access, right? So that puts us at a competitive disadvantage. So Cboe, we took a couple of things. We created, our midpoint discretionary order type that allows you to get discretion up to midpoint, and we amended it to allow for something what we call quote depletion protection, where that discretionary range gets disabled as soon as our display size falls below a round line. So what that helps you do is mitigate against adverse selection from that overly aggressive ISO order that normally, which would protect you from buying on a downtick, right? That's the one thing that you don't want to do. You don't want to sell on an uptick. So these are some things that we created to be able to compete with that. So we can say, all right, now put EdgeX and EdgeA, which are two markets that have that order type, to be able to be part of the non-display or ATS route. You've seen a couple of our competitors do that. And we felt that this was our way that's unique and different that allows us to compete with that. And you'll see something else come from us that I think will be also worthwhile that allows us to compete with conditionals and other block liquidity off exchange.
Little teaser. Nice. Love that, Adam. The we're going to move on here in 1 second, but and I think we got a question about exchanges. Are they discouraged from owning dark pools in the U.S.? Because if you think about Canada, you think about Japan, they had dark pools owned by the large exchanges. In the U.S., is it discouraged? What's that dynamic there? Are listed exchanges discouraged from owning dark pools?
Well, as you may have seen recently, Cboe purchased MatchNow from Virtu in Canada, which operates and functions as a non-display market center, right? The key distinction there is that in Canada, there isn't anything that, and obviously we still have a regulatory approval process that we have to get, approved from. But in Canada, you can own and operate an off-exchange vehicle as well as an on-exchange market center. The key difference there, though, in Canada, if you want, and we have a lot to learn from Canada, and I think part of, as we get through this exercise, I think it's very important for us to be able to learn from Canada, bring that to the U.S. and be able to say, listen, there's an off-exchange venue. When they want to file for fee changes, it actually has to get filed, right? Like an exchange. Where in the U.S., if you look at the ATSN, they talk about fees, it's kind of like ambiguous. It's not standardized. You can have a different fee for firm XYZ versus firm ABC, right? So Canada has some standardization that acts and feels like an exchange. Potentially, to be able to have an exchange in the U.S. own and operate an ATS, you could build that type of model they have in Canada. And keep in mind also in Europe, we own and operate a continuous lit book, and we also have a dark book, right? So if you think about the markets I just mentioned, we have Europe, we have Canada, two large equity market centers that allow exchanges to operate a non-display and a display book. But in the U.S., generally speaking, it's considered a facility exchange and it's frowned upon. So I think, potentially we could take a step back and figure out is there something that we could do there that mimics what Europe has. So there's a lot more, Europe and Canada has, so there's more transparency. But I also think it's interesting that you can launch an exchange that has investors that own and operate dark pools and other mechanisms that's off exchange. That's allowed, but an exchange can't own and operate an ATS. So I think that's a little bit of an issue that I think needs to get addressed, and I think we need to take a step back and figure out why we can do that in Europe, why we can do that in Canada, and then how we can launch an exchange that's owned and operated with investors that have ATSs and dark pools.
So Canadians, healthcare and exchange regulation are the
Yes.
the folks to emulate. Okay, good. All right, well, we'll move on here. I'm gonna, we'll try to come back and address some of these other questions. They're great, and keep them coming. We'll keep trying to address these questions as they come up. Let's kind of move to the topic du jour after 2/3 of the thing done and talk about Reg NMS, the proposed changes, 2 releases in January from the SEC, a result of a lot of feedback, but then also a result necessarily. I think there's a question of where the result of some of these kind of proposals came from. So just high level wise, we're talking multiple SIPs versus a single SIP today. Eliminate an MBBO and have some stratification between an MBBO and potentially a PBBO. And we have expanding the set of data as compared to the NBBO, but looking at the top 5 levels, auction information, so on and so forth. Changing the odd lot structure, so a tier structure based off the price of the stock, and then potentially requiring order display without protection. So a lot, one release was 575 pages, the other was 100 whatever. I'm sure you've read every word of both releases very closely, but in general, Adam, is your thoughts on this? You discussed kind of areas that need calibration within the U.S. equity markets. We don't need wholesale change. We need potentially better transparency. Do these proposals create more transparency in the U.S. equity markets?
It's interesting. I think just think about how long it took you to ask that question. And the number of elements associated with that. So I think again, this is something that's really important to put this in context. So if you go back to 2014 when we had the book that came out that we all love so much, you think about it, everyone talked about that we had too many order types and we had too much complexity in our market. And here we are working on a rule proposal, which is the market data infrastructure proposal. I know people phrase it as Reg NMS, but let's try to educate the overall community about what does that really mean. It's the market data infrastructure proposal that has a number of items associated with it. But keep in mind, we always have talked about that we've had too much complexity, too much fragmentation, and so on and so forth. And here we are going with another rule proposal that was been out there, which the comment period has ended, that creates additional layers of complexity. But before we get there, I think it's really important to highlight the one rule proposal, actually the order that the SEC approved in early May, which was around NMS governance, which really focused on a couple things. One, it allows a greater voice in the industry, so it changes the voting structure completely versus where it is today. So now the exchanges would have 2/3 of the vote, and then non-SRO members would have 1/3 of the vote. And now inactive exchanges no longer get a vote. And if you have an exchange group that's more than 15% market share, you get 2 votes, right? So what that really did was that was something that I think people have always had issues that there is not enough voice in the industry, and that's one way to solve for it. The other, there's a number of conflict of interest policies around it. And there was also another element where they talked about that if you owned and operated proprietary market data, you can't be the administrator of it. I would say in general, we're in favor of having more voices in the industry to be able to have a view and vote on products and services or pricing around, various structures. But keep in mind, you're also enhancing that conflict of interest. For example, now on the non-SRO point, you're going to have a market data vendor on there. So obviously there's a conflict of interest in itself because they're going to have a competing product and they're going to want to have something that works to their favor, right? So again, these are all things that be interesting.
Market data vendor with the exchange itself. Obviously, exchanges are totally, becoming more and more diversified, moving away from, getting money from, or the main source of their revenue is from matching, buyers and sellers to being technology providers and things like that. So you could have even more conflict or a consolidated level of more conflicts happening. Do you see that happening?
Yeah, I definitely think there's much more of a conflict of interest, and I think doing it through an order versus a rule proposal, I think is an interesting concept on how they got that through. But I think when you think about market data and you think about connectivity and everything else, I think there's three things that people have always had a little bit of an issue with. One is they need greater voice in the industry. Okay, well now we created the advisory committee to have a vote that helps solve for that. The other one is always around efficiency and distribution of the SIP data. So there's a big difference between the SIP and the direct market data feeds. The big difference is the SIP is generally top of book, that's price, size, time, and then the other element is the distribution of that data, right? Keep in mind, if I do a trade of IBM on one of our 4 market centers and it occurs in NY4 or NY5, guess what happens? And I then have to send it over the MAWA. So you have that geographical latency. So we actually put a proposal early in the year on a market structure reform document that said, you know what, one way to simply solve for that is your distributed SIP model. So that allows you now, if I trade IBM in one of our market centers, we just print it to the tape right away, and everyone has equal and fair access to that information. So I think there's a number of ways you can solve for a lot of this as opposed to doing a major overhaul. And prior to this, if you remember, the SIP operating committee put out for proposals about getting odd lots out onto the SIP, right? So I think it'd be more important for us to take a look at this. Let's do this in piecemeal. Let's evaluate the data. Let's fix. You can easily fix the geographical latency by creating a distributed SIP model. We're generally in favor of having a view or a voice in the industry from non-SRO members. But ultimately, I think, if you want to get more data and content on there, you don't need to go by the ways of the new market data infrastructure proposal, which is fairly intrusive, that basically creates a protected bid and offer, now an MBBO. And all that does is add additional ambiguity to the market. And just to even put it in perspective, from a wholesaler standpoint or a market maker standpoint, you have a paragraph and a half without amending Rule 605 that basically just says you need to look at now the new MBBO with no guidance, right? So those are things I think I take issue with, that it was just thrown out with the kitchen sink as opposed to trying to figure out, let's fix the geographical latency issue, which we can easily do. I think everyone is generally in favor of content.
Participants, Adam, so we can fix the geographical latency with the existing providers today.
Yes, we could do that through a distributed SIP model. And keep in mind, there's a lot of rigor. There's a lot of software development, testing, and processes the exchanges have to go through to ensure that the uptime is there. And if you think about it from a SIP perspective, it's pretty significant how long it's been uptime. There's been changes in the technology to ensure greater dissemination of the data as soon as they get the information and put it out into the tape. So I think you can solve for geographical latency and you can solve for content, and you don't need to create this 2-tiered market now that has a protected bid and offer and an MBBO. And all that does is create more ambiguity for everybody. And ultimately, as a broker-dealer, it's going to create more of a regulatory burden for yourself as well. Right. You don't want.
Right, and that's, if we think about what our customers are struggling with, it's regulatory complexity. It's dealing with these constant set of regulatory changes that are happening now, and then you add another set of complexity, especially as it relates to some of the Reg NMS proposals. If you think about ISO compliance, the number of steps that you need to take to stay in compliant with that, adding this another level of complexity, it's good for our business, but I don't think it's necessarily good for the industry there. Let's dig in a little bit more on some of the Reg NMS focus areas. So obviously we're throwing out the competing consolidators and self-aggregator concepts. you're not interested in, what about the core data? Do you think there is value to expanding the core data to, 5 levels and the auction information? Where do you stand on that?
Yeah, I think generally speaking, most folks were in favor of doing that, right? I think where you start creating a layer of complexity is saying, okay, under $50, a round lot is 100 shares. And then you're going to create, I think, I'm just going to look at my notes, but then you create $50 to 100 shares, a round lot is 20 shares. Then $100 to $500, a round lot is 10 shares. Then you have 500 to 1,000, a round lot is 2 shares. And then you have is a round lot is 1 share. But keep in mind, the protected stays as 100. So, I think that's where you start creating some issues. And then how do you go out to the public community and just say, oh yeah, by the way, your limit order that normally would have been protected is no longer protected, right? And I take, issue with that because it just adds an additional layer of complexity as well as ambiguity, and it puts a major onus on brokers about how they route, how they interpret the data. So I think let's take a small step forward, get some of the content available. If we need to go 5 levels deep, which is in the infrastructure proposal, let's go ahead and do that. If we want to get auction imbalance or other information out there, let's go ahead and do that. But if you think about it from an individual investor, if I go into, my online account, I'll just use that again. If I go into my online account, I want to buy 100 shares of Microsoft. I'm generally not setting a market on close. So is that imbalance information really that important for me to be able to have?
Right.
Those are the things you need to take a closer look at, right? Because if you think about everything that's always out there from a regulatory and other perspective, they always focus on the individual investor. And I still think the individual investor has a very economical way to be able to route to the market and find best price. And I think what we're trying to do with this infrastructure proposal is overly intrusive, and all it does is add additional layer of complexity that the average individual investor is not going to complain about.
Just want to remind everyone, I'm going to kind of go back through some of these questions momentarily. We'll get through kind of the end here, and then we'll definitely save ourselves a few minutes to get to a lot of these questions. Keep them coming as they're coming in there. So just, let's talk about order protection a little bit and talk about maybe locked and cross markets. A lot of times those things get lumped together. Obviously what you've said, order protection is still critical, and I've heard in other webinars and other content providers that the retail brokers, can't say it loud enough how order protection is so critical for their customers. Do you see locked and cross markets at the same level of an issue? Do you think that there is an issue there with locked and cross markets that the change in Reg NMS is trying to address or not, or does it need to be addressed?
Yeah, well, what I would try to do first, we have this, whole economic research department and everything else at the regulatory bodies. I think what I would attempt to do is figure out, why do we have locked and cross markets? Why do they still happen, even though they are prohibited? So I think the last time we ran a study, if I remember correctly, it was showing somewhere around 6 to 8% of the time we run into a locked or cross market. I think we need to figure out, why does that happen? And then number 2, if we are going to remove it, let's start at a small sample set of securities to figure out how well it works, right? And if you think about our volume today, the top 10 volume names are under $15 a share. That seems like a very logical place to start with, to say, okay, these 5 symbols will, let's remove the prohibition of locked cross markets and see how they function and operate. I think naturally the prices will form an appropriate bid and offer. And I think the right way to do that is, and I know we've had pilot fatigue as it relates to the tick size pilot, but I think an easy way to evaluate that is run a very small sample set of data, for 5 actively traded names, and figure out what happened when we remove the prohibition of locked cross markets, and then and only then can we make the right decision. I think we can't do this off of knee-jerk reactions and anecdotal information. I think we always talk about big data and all this information to be informed about the direction that we go, and I think we're at a point in time where it's important to evaluate data, and that will help us get to the right decision in terms of things like prohibition of, removing the prohibition of locked cross markets.
So in general, SEC not going in the right direction, at least with these current proposals on order protection, locked and cross markets. There might be some flexibility where maybe a really targeted pilot is in order to see if that's an issue that can be addressed or should be addressed.
Yeah, I wouldn't say that the SEC is going in the wrong direction. I think they have the best interest in place for the overall industry. I just think you don't need to do something as robust as a 500-page document about a potential rule proposal. But that is the beauty of our industry, right? The nice thing is you can put the order out, the proposal out there. You can then get all the comments. You can read all the comment letters, depending on the constituent. Everyone had a different level of, response to it, I think. But for the most part, the majority of the letters were not in favor of creating this, protected bid and offer in the MBBO and ultimately getting rid of a protected market center. So I think they should probably take that into consideration, and that's the benefit of having, the comments that are out there. And I would do the same thing for, potentially removing the prohibition of lock cross market. Put a proposal out there. Let's get that separate, evaluate the comments, and then potentially run a very small pilot and evaluate the data and make the right decision.
It seems so simple, Adam.
It
so
does.
let's start working through some of these questions as we're getting to the kind of final quarter here of this. Just smoking by the way. You just people are very excited to ask questions here. So talking about first question here, how does the very crowded options marketplace, meaning the number of exchanges, complicate a truly meaningful Reg NMS? So I take that question as we have new exchanges all the time. There's every new exchange effectively adds another level of complexity. And, you have not that many exchange groups, a lot of consolidation there, but new exchanges all the time. Do you feel like, what's your thoughts on, do we need to do something? Do we need to set a minimum threshold for exchanges to be able to participate in some of the NMS pieces, or no? It's buyer beware and let the market decide.
Yeah, I think there has been a number of discussions historically where people threw out a couple ideas around, if you're less than 1%, then you're not a protected market. There's some of that also in Canada, which we can learn from there. We can study how that progressed in Canada and determine if that's the right step for us to take. I think it's a hard decision to be able to make. I think if you put it in context why Reg NMS was written, it was originally proposed, I think, in late 2003, then, kept getting amended in 2005, and then eventually approved in 2005, and then approved and then implemented in 2007. They did that to make the markets more efficient, much more electronic. If you remember, there was a massive fine and disgorgement of profits on one market center. So that helped, alleviate those concerns and issues. But here we are, 13 years later, and we really haven't done much, as it relates to Reg NMS. So I think, there is potentially some merit there that we have too many market centers. However, when you think about it, we've only had really one new exchange in the last, 5 to 7 years. And if is that really a major onus on the industry? Probably not. I do know how long it takes to allocate resources and then connect to that. It's not a significant overbearing issue. But, you could also look at it on the flip side. We have 40+% trading off exchange with 30+ ATSs and X number of SDPs and so on and so forth. Potentially that's probably a market center that we want to focus on. And it doesn't mean, get rid of them, but potentially provide more transparency. And once that transparency is there, you can make an appropriate evaluation of the next steps to amend or change Reg NMS as a whole.
Right. Question we had, can you please elaborate on the enhanced SOR reference on this slide right here? What we are referring to, smart order routers obviously have made huge strides over the last 10, 15 years dealing with all the regulatory issues. Maybe Adam, you can put your BD hat back on and talk about how much time you spent on your SOR and how the level of efforts that needed to, or resources needed to make that something that was really valuable to your end customers.
Yeah, I think many broker dealers do a good job of incorporating changes in a smart order router. Obviously, on post Reg NMS, there's been a lot of regulatory change to ensure the integrity and stability of the market as well. LULD or Reg SCI or Rule 201 and 204. I think those are all generally very necessary. It does take a lot of time and effort and allocation of resources that does take away from other revenue opportunities, whether it's improving your OMS or improving the facilitation of order flow, upstairs, meaning pairing orders off, or building a central risk book, or enhancing a number of other items, whether it's your algorithmic suite or your direct market access connectivity layers. It does take away from that, but I do think it's important for the overall integrity of the market, and it does take a lot of time and effort. But keep in mind, the exchanges had to go through the same process as well, particularly around Reg SCI, to ensure all our systems are have proper policies and procedures for development and software cycles and release, and working with the industry to test that. So I think we've all felt the pain of it, but I do think ultimately at the end of the day it benefits us, and we've really seen that over the last 3 to 4 months, particularly with all the increased volume and volatility.
Yeah, absolutely. Question around, or more of a statement, or get your thoughts on maybe a rewrite of 605 and SIFMA execution quality might make more sense, and slap odd lots on the tape, leaving round lot sizing as it stands. Thoughts on that? Yeah,
I would say enhancing 605, and not to date myself again, with those of whom would know me are probably chuckling, but I'll say 11AC1-5, when it was originally written and then rolled up into Reg NMS, it was the late 1990s and implemented in the early 2000s. One of the reasons why we did that, or the industry did that, was to help ensure that firms satisfy their fiduciary obligation to find best price and use appropriate execution statistics for their routing. And then 606 provided additional disclosures, which we recently enhanced when it was approved in the latter part of 2018. So if you amended Rule 606, I think it makes sense to update Rule 605. I do know some market centers or brokers now incorporate odd lots and utilize 605 statistics for routing of those order flow, of the order flow. I think that would make sense. So I definitely think a close review of 605 is required. And something early in the year that Cboe put together, we talked about, potentially changing the round lot sizes for stocks above 500 shares, which I think it was roughly 13 of them or so, potentially moving that down to 1 shares or 10 shares, and evaluate the performance of that and figure out, okay, now do we need to take it a step further and go from 250 to 500, and what would be the appropriate size or round lot for those stock prices. But keep in mind, if I'm a broker dealer, then I have to start adding that into my system. But I do think taking a small step forward would be very beneficial about determining the appropriate round lot size. And I think starting with stocks above $500 would make sense.
That sounds right. We'll try to do one more question here, and then we'll start moving into our predictions. I'm sure everyone is anxious to hear that. Question: Cboe has publicly supported enhanced governance, but is suing the SEC on their proposal. What aspects of the SEC's proposal do you disagree with, other than, quote, greater conflicts it would introduce?
So I think, even if you look at the market structure, market data infrastructure proposal that went out, they have competing SIPs. So I think that adds an additional layer of complexity, because keep in mind today, exchanges and the UTP and CTA and CQS, when all that information is out there, everyone has equal and fair access to that information. If you push this out to competing SIPs, think about it. They're going to want to be able to have a full service product offering that's available for all broker dealers. So if I'm a large bank or a large broker dealer, I'm generally going to get a beneficial price. And when we talk about competing SIPs, there isn't anything in there. I mean, correct me if I'm wrong, but there isn't anything specific that talks about the regulation of that, right? So if I'm a small broker dealer and I'm only going to use them for the SIP, is that probably something they're going to want to get into? Probably not. And if you remember in the SEC in the document, they talked about the implementation roughly being $5 million for the cost of implementation for competing SIP. So there's many market data vendors out there. I do think they would have different classes of products and services and fee schedules available depending upon what you're going to utilize from them. So I think we have to evaluate that a little bit further, and I think we also have to understand that exchanges have a significant amount of regulation they have to adhere to, and compliance around stability. And I think, I think that's an important element that we can't, lose sight of.
Perfect. All right, so before we get into a few predictions, wanted to let folks know that yes, a recording will be available that you can watch over and over and over again to your heart's desire. Watch Adam just 24 hours a day, and that we'll send out an email tomorrow around that, and it will also be available on our websites. Follow-up questions you can send to us. We'll make sure our contact information is on that email as well. All right, so final 5 minutes, 4 minutes, let's talk about a couple predictions. One, what survives, what pieces of survive from the two proposals? Like, you put your hat on, or your prediction hat, what survives out of these two proposals?
Well, I think an important time frame or date for people to look at as it relates to the governance order around market data that was approved. They have 90 days to submit that to the SEC. So I believe it's on or about August 10th or 11th. That proposal has to go to the SEC for review and potential approval. So I think that's an important date for everyone to keep on their calendar and figure out, and so they can understand the next steps that happens with that. As it relates to the infrastructure proposal, I mean, if you go up and down all the comments, I think there is a tremendous pushback around creating a PPBO and an MBBO, and I think it would make sense for us to remove that, and I think it would make sense for us to focus on solving for latency through a distributed SIP model. And I do think it's important for us to have greater content available on the SIP, and let's start there. And then evaluate and work with the industry, whether it's through the retail or buy side or other parts of the market participants, and see what benefit they receive from that, and then ultimately make the appropriate decision about the next steps thereafter. But I think ultimately solving for the geographical latency and getting the content would be the easiest thing to do without creating additional ambiguity or levels of complexity that the current proposal has embedded within it.
Yeah, that makes sense. I tend to agree that not much is going to survive out of the existing way they're framed or anything else. It just doesn't seem like there's a big industry. But it seems like the pushback is why are you going to make things a lot more complex when a lot is really working in the right direction, and it needs fine tuning as compared to a sledgehammer approach. And so
yeah, and then just one other comment, if you don't mind, I would say the other part is getting back to what we've been focusing on the last couple of years, and that's really around innovation and uniqueness, and giving exchanges like Cboe the platform to be able to provide new functionality that has less of an arduous process. We did that with Retail Priority, we did that with QDP. We'll have another one coming in the next couple of weeks, and I think it's important that the exchanges are able to do that at a level that's consistent with other market centers, and I think it'd be very important for the regulators and the industry to focus on that, and ultimately that will benefit individual investors as well as all investors about when and how they want to be able to trade in our market centers.
That sounds right. Okay, yeah, exactly. Non-industry over under on any major sports being shown for the rest of 2020. Adam, what is the over?
Well, ice hockey. I think that's going to happen.
Very Canadian. Again, you're leaning Canadian, really the majority of this time here.
Well, I'm partial to that because my son is pretty adamant. I travel the country for that, although we won't be doing much travel right now. But I do think ice hockey happens. I just think hockey, baseball, I think is a foregone conclusion, may not happen. I think there's a very good chance we get college football based on what we're seeing with some of the start dates with the colleges starting a little bit earlier and then potentially ending right around Thanksgiving. It's too much of a moneymaker for them not to have it. So I would say college football and ice hockey.
I like it. We'll see. Texas is struggling a little bit. We need football down here, but who knows? Well, anyway, on that note, really appreciate everyone. The questions were great. Hopefully you got some nuggets of wisdom. Adam, couldn't thank you enough for joining us. Really appreciate it. Again, an email will go around with the recording. Any questions, we'll make sure our contact info is in there. And thanks for your time. Take care, everyone.
Thank you, everybody. I appreciate it. Thank you for having me. Take care. Bye-bye.